Hello, everyone, and welcome to today's Trend Watch webinar presented by Evenco and Bloomberg Intelligence. Today's topic is enhancing ESG integration, unraveling the essentials amidst information overload. My name is Eric Kane. I'm the Director of ESG Research for Bloomberg Intelligence. I'll be your moderator today, and today I'm joined by a very exciting group of panelists. First, Marcus Mueller, Chief Investment Officer for ESG and Global Head of Chief Investment Office for Deutsche Bank Private Bank. Austin Robiliard, Investment Director from Murdoch Asset Management, and Kara Williams, Global Head of ESG and Sustainability at Mercer. So to kick us off, I think we'd all agree that there's considerable noise around ESG these days. And I wanted to hear from our panelists how they view regulation, some of the opposition, and the future of ESG. And Kara, maybe we'll start with you.
Sure, thanks. Yeah, I mean, it's almost a shame that ESG has been a bit hijacked, really, because I think at the core what ESG was meant to be was really effective additional insights into investment options, sort of non-financial information that was made available, how well an organization is run, how well it takes advantage of the environment that it operates in, as well as how well it cares for it, but also on social standards as well as governance ones, right? So the fact that it has somehow become politicized is truly a shame, because it's really nothing to politicize. It's not about exclusions. And what we're seeing from Europe is, I think, if anything, encouraging, and is across all aspects of ESG. We've got new regulations to be coming out even on equal pay across Europe. So S is being looked after, if you will. And then, as we know, environmental has been, I think they've far surpassed any other region in the world. So, for me, it's bright days, at least in Europe, and hopefully, that influence will actually encourage other countries to see it as, again, good business management rather than something that's about exclusions.
Absolutely. Thanks, Kara. Marcus.
Yeah, so a very relevant question. Although I agree with the fact that we need regulation and we need more clarity around the definition, we should not get scared by it. And on top of this, I think we all have to recognize that when a society seeks for answers, this just goes through discussion. And discussion means also different opinions. Even if it feels uncomfortable what we are going through right now, this is a way of how we find our way to deal with this, as Kara has said, this non-financial dimension, which is clearly a pecuniary dimension in the end as well. What the society now starts to understand is that we now have to maybe work on two priorities. One is the traditional economic priority, when we analyze companies and our investments. And on the other side, it's really this new quality dimension of ESG. And on top, no one said that it's additive. No one said that it must be E plus S plus G. And exactly this we now try to understand as a society. And on top of this, we have different regimes, but these different regimes are a normal reaction function based on the different underlying market structure. Social market economy in Europe requires a taxonomy. Same counts also for many Asian countries. In the US, the finance flows rather through the capital market instead through the banking sector. Hence, we do not really necessarily need taxonomy. But to understand this means also discussion, but also definition. And maybe we will come later to this. The definition is more or less an exercise to reduce information asymmetry in order to make sure that investors are talking about the same. And if we go back in history, we had the same about PE, price to book, and so on. All these metrics have not been defined from the beginning of human existence, right? So this is something I think what we need to appreciate. Hence, it is our remit of the four of us, as well as of other experts, to contextualize what's happening here and not seeing this as a threat, that this is rather the necessity in getting an answer to the open questions we have.
Wonderful. Thank you, Marcus. Yeah, a lot to follow up on there, but before we get into some of those other points, I wanted to hear from Austin as well on the initial question.
Thank you, and hi everyone. Well, we view regulation as a quintessential bolt in the stable door once the horse is bolted. The market sets the direction of travel, and where we see regulation really fitting in is kind of reinforcing that direction. So ESG has been around for many years. There's the first ethical fund in the UK was launched in 1984. We're not talking about new concepts, but what we are seeing is a societal shift in how our consumption patterns, particularly our conscious behaviours. So consumers are demanding that the products they buy are not environmentally damaging, that companies can demonstrate their green credentials. So what we're kind of seeing, or what we're hoping to see with the regulation, is the direction of travel has already been set. And as my esteemed panelists have already mentioned, Europe is ahead of the curve, particularly when you look in some of the Scandinavian countries and around the rules on pension. And that ultimately, they've actually got state regulation that says that there are ESG considerations for these large state pension funds. In the UK, and I've very much got a UK hat on, we don't have that yet, but I'm hoping that that's what will come. And what it will stop is not necessarily that we're going to change the direction of the market, but it's going to stop it from doing a U-turn and coming back on itself. We've got a climate emergency. The naysayers are fewer and far between. You just look around what's happening across the globe. I don't think there's anybody here or any learned individual who is saying that isn't true. And capital markets have got a role to play, and the regulation has got a role to play, but we need to work together in order to ensure that we're going to get to the desired outcome.
Wonderful. Thank you, Austin. So yeah, a lot to kind of follow up on. Some of what we're hearing, of course, is that the direction of travel has been set. Obviously, we need action from both the capital markets and regulation. But in my mind, some of the rhetoric that we're hearing, certainly here in the States, is kind of suggesting that ESG is a monolith, right? And in my opinion, there's a lot of different ways to think about some of these concepts. And I wanted to hear from you kind of what your guiding principles are for ESG integration in your roles specifically. So maybe we'll flip the order here, and Austin, start with you.
Thank you. So kind of following on from what Marcus said, what do these terms actually mean? So we've got a number of funds that call themselves sustainable, SRI, ESG, responsible, impact. I don't know what the difference is between a sustainable fund and a responsible fund. Can somebody please educate me? Where in the textbook does it tell me what ethical actually means? We've all kind of stumbled across this idea that ethical's got a negative screening and SRI's got a positive screening, and then we've kind of evolved to ESG, which again is not a new concept. I'm yet to meet an active manager who didn't consider governance as part of their inputs of their analysis, particularly of company management. So to get around all of that, what we developed when running our ESG portfolios is a matrix that looks at the hard wiring of funds. So as a fund selector, I'm presented with all of these different marketing cliches to actually try and strip the important information from the not so important information. But ultimately, what I want to ensure for our clients who have got ESG considerations is that I buy funds that are suitable for them. So when we say hardwired, we mean it's enshrined in the fund's prospectus or the objective, where it's got limitations around the capital allocation. So a lot of funds will say they're ESG integrated, but if you ask them, can you buy a tobacco company? They would say, oh, well, I wouldn't. So yes, but can you? Are you actually allowed to? And that's where we make the differentiation, in that if they are physically prevented from doing so because it will go against their fiduciary duties and it would breach internal systems, then I can feel comfortable that that fund is suitable. If they just say, oh, well, it's not the way we think, then I feel uncomfortable around that. And for our systems, that fund would not be suitable for our ESG portfolios.
Very interesting. Thank you. Marcus.
Yeah, so when I talk about ESG and when we work on ESG, we are always guided by the genesis of this term. And the genesis of this term, if I'm not mistaken, was really by the United Nations in the report Who Cares Wins, where it was brought up more or less really the first time in this acronym, and where it's saying, let's think about corporate activity in the context of the limitation of the resources we have available, and under the consideration of labor law, of inclusion, as well as good governance. And when I analyze a company, I really think about this, means how does it affect the planetary boundaries? Is there a transformation risk, a reputational risk, a physical risk, or deriving out of this, a liability risk, a effect on cost of capital because the risk dimension for companies' activities completely change and capital market will depreciate this. Controversially, we also have then to ask the question, if companies understand these risks, what does it mean for their business model? Do they report on this? Have their strategy in place to overcome these potential hurdles? Do they understand that, now taking it up, that climate change is a risk for them, and hence investors are trying to understand this? So I must report as a company my climate strategy, not just mitigation, also adaptation, as I otherwise will feel potential physical risk. And when I see such kind of reporting, for me as an investor, it's transparency. And this transparency I like, I appreciate. And if at the same time the economics are correct and solid, there is no hindrance for me to invest in this company. This is something how I try also to discuss with my stakeholders like portfolio managers, exactly how ESG must be understood. And it's not going in your direction, Austin, but if someone is saying ESG is not defined, look at exactly this report, look at the 70 SDGs with 169 sub-goals. What do we need more, right? We just need to agree on the one side, it's not bringing our planet to planetary boundaries or breaking those, including societies in economic activity and doing it in a transparent way that risks are that they are prudently managed in a company based on economic outcomes or KPIs. If we bring this together, ESG is for me really a qualitative additional dimension to my normal analysis I do at the market.
Yeah, I think I fall sort of right between Austin and Marcus. So, we have an interesting role as an organization because we work with corporations trying to, they're kind of on their own ESG and sustainability journeys, identifying what areas they believe they can focus on, which ones they can improve upon, and then which ones they actually don't feel that they can potentially work on and improve on in order to make themselves more transparent and be able to articulate that better for investors like Marcus. And then on the other side, we work with asset managers, right? Assessing asset managers on things like their ESG integration versus impact. And I think this nomenclature issue has been around for quite a while. I would debate whether or not you ever even need a fund to be called ESG. I don't see how it is. It's as Marcus says, it's an additional dimension when you're assessing an investment. So how do you kind of put like, and I think it was Austin who said, how do you put governance to the side, right? It's not sort of well, no, for this fund, we don't consider governance, right? That makes absolutely no sense. And I don't think anyone wants to invest with an organization like that, or, slave labor. No, that's okay. That's fine. We don't consider that an issue. So I think the nomenclature is a big issue. And then you look at the United States, I think in particular, ESG has become the negative term, right? So you now have states that are clearly stating that they will not work with an asset manager that takes ESG into consideration. But this is where to Austin's point, I would be quite dismayed if an organization, a fund manager said to us that, they take ESG into consideration and they don't invest with a tobacco company, because that's exclusion to me. That's something different. That becomes more values-based. I want to be able to hear an asset manager be able to justify why they invest maybe in one oil and energy company versus another one. And then maybe they're taking into consideration, is the regulation that's helping or hurting? Are they on a transition towards renewable? Because actually that is a more sustainable model. And when I say sustainable, I'm not talking about environmental sustainability. I'm talking about organization sustainability. Are these people going to thrive in 10 years, 30 years? So it's a good long-term investment for me. So I think it's an important this whole game really, there are, and to Austin's point, there are so many ridiculous titles and names of funds out there. To me, impact still kind of has a place as its own thing, but there's so much lack of clarity as far as to what are you trying to impact. You can't impact everything, right? So I think people probably need to get a little bit more specific on their impact names of their strategies. But yeah, sustainable investment or an ESG investment, to me, it makes no. I don't see really the value in that. I should hope that anyone's making an investment is investing in an organization they believe is going to thrive in the long term.
And maybe Eric, if I quickly may, to add on what Kara just said, we also need to be very clear about what we are doing. Right? When you invest at the secondary market, you won't touch really directly the capital situation of a company. You just buy or sell with a counterpart on the market, but not with a company. So I don't get it. How can you call an impact fund impact when you trade at the liquid capital market? There you just have a return and risk position as an investor. If you want to have impact, you need to have a decent degree of control of the company's strategy. And then through the stake you own, you have impacts. The question is how strong this impact is. And then we are rather in the private equity discussion, and the more direct your investment is or your stake is, the more impact you have. And also this means, for me, overall together what we've just said, we need a new kind of financial and economic literacy, as this is nothing new. This is really nothing new. And this is our task, to provide this and to contextualize this, because then it's anything else than scary, then it's just a rational choice.
Absolutely. No, that's interesting. Just to follow up on one of the last things you mentioned, Marcus, which is, this is nothing new. I would certainly agree. A lot of the issues that we're talking about within ESG, the terms, the metrics, et cetera, a lot of it is not new. Many of us on the call have been in the space for a long time. But I think one thing that is perhaps a little bit new is the kind of frequency with which we are seeing major climate events. It seems like now it's multiple a day, whereas perhaps a couple of years ago we were still thinking as a lot of these things will be somewhat in the future. So given that hardly a day goes by without a new climate event, I wanted to hear from all of you why climate remains a focal point for ESG, and ultimately how you're looking specifically at climate, whether it's carbon performance, transition, physical risk in your decision making. And Kara, maybe we'll start with you.
Well, I may steal from Marcus because I believe he may have already used the term, but yeah, I think it's very much focused on transition and adaptation, because unfortunately, like you said, the speed with which climate change is now affecting, I think, is becoming blatantly obvious, and we really haven't prepared ourselves. There's lots of countries that are particularly exposed. One thing you even see now is, which brings kind of S into this piece, is sort of disenfranchised communities, even in developed countries, who suffer more from climate change than others. So you see the need for adaptation even on health coverage, having to sort of shift its own focus, right? Because people are exposed to things that they weren't necessarily as exposed to even 10 years ago. So for us, it's very much around those areas. Transition, I don't think anyone's really comfortable. If I think of most of the really large corporations, and most aren't comfortable with making very drastic and fast movements in this space, unfortunately. You do see a lot of acquisition, luckily, of smaller firms that are making those big strides. But for now, adaptation is going to be kind of the main way to survive, and certainly in the next 10 to 20 years.
Mm-hmm. And if you're looking to measure adaptation for a particular company, or helping guide companies and how to do that, what are some of the metrics you're ultimately using in those processes?
So I think this is where the insurance industry is really at the forefront. They've done, mainly obviously because their own businesses are heavily exposed to the risk themselves. So it's not done altruistically necessarily, but it's certainly they are well ahead of the curve. A lot of it is actually assessing physical risk, even going down to the level of people risk, and it's hard going to do that. This isn't to sit at your desk and assess these things. It's a lot of the times it's actually genuinely kicking the tires, which they do. So.
Great. And Austin, maybe we'll hear from you on this.
Thank you. I'll give you an anecdote. I remember being at school and being told that oil is going to run out in our lifetimes, and isn't that terrible because we're going to need a new fuel source, rather than isn't it terrible that we've got this fossil fuel in the first place that we're so reliant on. And now we fast forward, I'm now 39. I know I'm older than I look, and we are on this precipice of this energy transition. But what I don't believe is that you should be starving companies of capital. But also, I don't believe that oil majors and mining companies are suitable for clients who have got environmental considerations in their investment. So there's a place for everything. And that's where it becomes quite a difficult path to tread, because we want these companies to transition. We want them to adjust their organizations going forward. We want them to be sustainable and to do no harm, but also that costs money. And ultimately, economics wins. Every time we moan that we're under-resourced at work, or that the queue at the doctors is too long because we can't get seen, or our roads are in a poor state, it all comes down to one thing, and that's economics. And that's where we are with all of our capital allocation. And when you go back in history and you look at the Industrial Revolution, natural capital was not factored in at all. And here we are now, 200 years later, our environment, we have a climate emergency, and that's because of our dependency on fossil fuels. And yet at the same time, we in the West are telling countries you can't use coal, or you shouldn't be using this or that because it damages the environment. And they're looking at us going, well, you used it and your economy's better off. Why am I not allowed to use it? You didn't factor that in. Why should I have to do it? So it feels like we're hypocrites, and it feels like we've got no moral high ground. And yet we're asking others to adjust at the same time that we're adjusting. So we benefited, as Cara says, you've got countries that are, and societies that are really feeling the pinch of it, and we're not helping them out. So I think we need to have a rethink. Ultimately, I'd love to be able to change stuff in this call. I'd love it if we've got journalists, if we've got politicians, if we've got people who have been voted in to represent humanity. We've got COP28 coming later in the year. We need to make natural capital a fixture of our capital allocation decisions. We need to value it properly, because economics will win. We will go for the path of least resistance, and we'll go what's going to give us the biggest profit. And if that means that the environment takes a back seat, as it has done throughout so far human history, that's going to continue until we are forced to do, to change. So that's really where I put my 2 cents in it, is we haven't valued natural capital enough. And yet here we are in the state we find ourselves in. Let's do something about it. Preach over. Well, actually, it isn't. Yep. Preach paused.
Maybe I'll ask you the same kind of follow-up.
I'll say amen to that, Austin. That was you articulated that very well. Thank you.
Also, maybe I'll ask you the same follow-up question I asked Cara, which is, you spoke about natural capital, the need, of course, to assess that. So maybe walk us through a little bit kind of how you do that in your role. What are some of the metrics you're looking at? How you're ultimately defining kind of which industries or sectors you include in that assessment, or if you think all sectors should be included in that natural capital assessment.
Absolutely. Well, I think every investment decision should have a natural capital element to it. But when it comes to us and what we have our unconstrained portfolios, which are for people who don't have any ESG considerations. This is, we're unconstrained, we'll go anywhere, buy anything. We obviously want it to do no harm ultimately, but there's no overlay or definitive nature to ensure that happens. Whereas in our ESG portfolios, which we've been running for our clients for just over 7 years now, we have very strict rules around what is and isn't permissible. So in our ESG portfolios, there will be no exposure to oil and gas. There's fossil fuelers are not permitted in it. The effects to sin that we're all familiar with, they're excluded. And also, crucially, where we think it's slightly different is that there is a hardwired positive impact in terms of we are investing significant amounts in renewable energy. So we're actively promoting investment in renewable energy, as well as looking at the societal impacts. So we got not just positive business practices or looking at the supply chains to ensure that there's no slavery or that you're doing things the right way for the right reason, but also that you're actually empowering people, you're promoting them, you're giving them opportunities in order to achieve and succeed in life, whereas that wasn't necessarily the case beforehand. So that's where I would draw the distinction in our portfolios. We do have some of the dirty old school stuff, but we've also got the kind of cleaner, nicer stuff. And we do have that differentiated in our product range.
Interesting. Thanks, Austin. Marcus, your thoughts on this question?
Yeah, I agree in essence with Austin, but I would phrase this differently. Because natural capital, I like this term and I like the idea, but we have to remind us a little bit what really the failure is we are facing and we try to solve. And the failure is that we do not factor in our economic decision making the systemic value of nature. So we really do not distinguish between stock and flow and price and value. This is something what we since 100 years-ish have completely forgotten since we introduced in the 1930s the GDP. Because disagree with Austin, we had in the 1930s a national evaluation based on natural resources, mainly commodities, right? But we already had the idea of stock in the economic system, but we abandoned it in order to measure rather the value creation through the flow. So what we can strip from nature and where we can put a price on. And due to this effect of creating efficiency in our measurements, we've really lost sight in regards to the value and the stock discussion. This means that when we agree on that everything what we produce comes to a certain degree from nature because it's an ecosystem service, we should not destroy the machine which sustains the service. So this is a little bit the underlying idea. So we need, unfortunately, not to start at the company level, rather to start at the system level, which is really understanding the relation between the, from me, so-called market demand structure, because the human demand, which we define as manufacturing, energy, mobility, and food, have created a dedicated supply structure. And now we need to understand how this supply structure is harming the value of nature, and so that it potentially causes the collapse or the degradation of the quality and quantity of ecosystem services. When we understood this, we can then start to discuss system change in the value chain of the corporate. And the most simple example is the circular economy. But this is the most simple example. And if we apply this then to the value chains and the discussion, we get already a direction of travel. Nonetheless, there is one missing puzzle, and this is, again, on the national level, to evaluate the natural resources we have. And here the United Nations has provided already a system, the CEF system for environmental economic accounting. We now have really rigorously to implement this to make sure that we also then can plug the potential negative externalities of a corporate action towards the natural habitats or resources we have, in order then to incentivize the companies to change their behavior. And this is something I think which will happen in this decade. And we know this already through the discussion of biodiversity credits, means species abundance, which is exactly this. Do not harm biodiversity, and then you maybe will get a tax advantage, something like this. And in this direction we have to go. And then I agree completely with Austin that if we apply this, we also will really put in our portfolios a kind of bottom, a kind of hedge in regards to the risk companies potentially will fall in, because they start to understand their position in nature, in their value chain, and what it means also from a physical risk perspective. Nonetheless, how do we do this? We analyze funds and investments based on their double materiality. Because even if it's classified in Europe as 8 or 9, it doesn't tell me anything about its double materiality to the environment it's embedded in. And if we have a conviction on ocean, I can't give a client with good conscience a product which has a negative double materiality to the ocean, even if it's classified as A. So in this direction we go, and we have to go further. And in the end, let me conclude with this. All these information must be mainly public available information, because this is nothing which should be proprietary. This is not a competitive question. This is a question of, are we still able in future under this planetary boundaries limitation to provide ecosystem services through our economic production process in order to create prosperity for our society? And if we say no, if we proceed like this, then this is an imperative, right?
Yeah, and then back
Sorry,
to your,
it was a little bit exhaustive.
no, that's perfect. It's almost back to your point on the circular economy. I mean, we genuinely need to have those frameworks. So I mean, I try not to be too skeptical and have the hope that corporates do intend to do well and do want to provide information for investors to be able to make fully informed investment decisions. But there are so few standard frameworks for them to provide that information. So when you make things publicly available, the problem is, as an investor, how do you compare apples to apples when people are just kind of, in theory, again, I'm trying to be sort of positive in the view, but they're all trying to provide information, and it's all going to look different because nobody has set a sort of a standard. You referred to the environmental accounting, which is, and there's so many good starts, right? That's a good start. TNFD is potentially a good start. But as you have corporates that are multinationals, it's very difficult for them when different countries have different regulations and different reporting standards, and we just need to start consolidating this and making it more feasible for them to provide information for you to make better investment decisions.
I agree with Kara, and I try to be not German and hence not negative. So therefore, I wanted to be positive. But as a German, I have to say, though, I share your skepticism about the speed. But this brings me to the point that we have seen it now in Europe. We could have afforded a decentralized energy supply based on renewables already 10 years ago. Unfortunately, we had to face a horrible situation which created such a scarcity on cheap fossil fuel-based energy that we started now to implement and rediscuss the renewable energy and also the resilience character of decentralized energy. I fear, based on my sociological background, that it will get worse before it's getting better. So usually innovation just starts when there is a tension and a scarcity. And we will face the scarcity in nature, and we do this already coming from climate. And we will face it also from food supply, through biodiversity loss. We see this already in many parts of this world, and then the world will start acting. And this is maybe the brutal truth, but we can prepare for this.
Absolutely. So just to follow up on an acronym that Kara mentioned, TNFD, which of course is Task Force on Nature-Related Financial Disclosures, that's a framework that is out kind of in draft form right now, will be finalized later this year. So I think we're all optimistic that that framework and others that have been developed or are in development will help us with kind of this question of lack of standardization with respect to biodiversity reporting specifically. I guess biodiversity is certainly one topic that is very timely, certainly in the wake of COP15 and the big announcement that was made there with respect to biodiversity. A lot of attention has been paid. It's something we're doing a lot of research on at Bloomberg, and I think whether you take a slightly pessimistic, optimistic view, there is certainly progress towards trying to get better disclosure, progress in terms of corporate setting targets related to biodiversity and trying to minimize their impact there. On the flip side, I see some kind of social issues, maybe cybersecurity, for example, being an issue where we know there's a lot of impact. And in cybersecurity, I'm thinking about things like data privacy, customer privacy. We know there's potential impact. We know it's a big issue for more and more companies these days as everything migrates to digital. And in Europe, we certainly see some kind of strong regulation. But as someone who tries to analyze companies on issues like this, I see a just fundamental lack of disclosure on the issue. So wanted to hear from all of you kind of where you see some of the other, key, more emerging topics, how you're able to address, the lack of transparency, especially when we don't even see something equivalent to TNFD coming down the pipe. So maybe Austin, your thoughts.
Sure. Well, just on the biodiversity one. So obviously we're asking companies about their carbon output. We're looking at them, do they offset? And I think that actually links together, that we're essentially saying to companies, you can go and plant trees to offset your carbon, but one tree isn't the same as another. So if you've then got some reforestations that are happening, but they're all using, say, the same kind of tree because that scores better on their system because you can grow bigger trees and therefore offset more carbon, you're actually still fueling the problem of the biodiversity issue. So that, first and foremost, just wanted to put that out there. Obviously, say the lack of data, I think not so much the lack of data, but the lack of consistency across all the different providers. So whether you're looking at the S&Ps or Morningstars, I don't appreciate Bloomberg, you've got your own stuff, but the correlation between these companies is pretty poor. There's no consistency among them. So not only are we then saying, well, what data do we want? But if you're using a data provider and one says this, and one says that, one says that, it's just an absolute minefield. So it makes it really, really hard to make an informed decision. Now, I appreciate that my esteemed colleagues, Cara and Marcus, a little bit more on the institutional side, they will have a much better handle as to what's coming out new. I'm on the retail side, and we kind of get the scraps of the table, if you will. And also the sophistication of our clients is such that they wouldn't be asking us about cybersecurity over biodiversity, over any other issue, but we just hark it all together to, well, do no harm. And following or continuing my rant, we currently place more value on data than we do on the environment. You look at it through GDPR or States or in Europe or where else, I'm absolutely right. Private data should be private, and companies that mishandle it or that leave themselves open to breaches or it being available to others should be penalised, and rightly so. But conversely, how can you say that data is worth more than Mother Nature? So I, again, kind of bringing back to earlier rants around it, is I think we need to not focus on just one area, and we need to also be aware of areas that we're falling down in. So if we look at what we're doing and the impact that we have of all of our behaviors, of our consumption patterns, of our wastage, you name it, we need to take a hard look at it. And unfortunately, and I appreciate I might be waffling a little bit here, but particularly around those 2 points that you raised, the fact that one we value and one we don't, or one we don't do enough. And there are many other instances that I can give you. But I'll let my colleagues who are chomping at the bit to add.
Yeah, I would just add, I mean, before earlier I mentioned the fact that we work with corporations as they try to establish what their own sustainability journey is going to look like and set targets across things. The main issue, I think, with ESG is it's so vast, right? Marcus already referred to all the subcategories of the SDGs. ESG doesn't even have subcategories, really. I mean, nothing's laid out. So it could be just about anything. I mean, 10 years ago, we've talked about the fact that ESG has been around for since the 80s. Cyber certainly never was part of it. Now suddenly, sort of cyber is being thrown into part of the conversation. So Eric, I actually appreciate you throwing in cyber as part of ESG because we put it under G for governance. But again, corporates can't be all things to all people, and they all need to assess what they can control and can't control, and where they believe they actually can make a difference and sort of drive their businesses forward. I think the vast majority of organizations that are very data reliant have become focused on cybersecurity. Whether or not they're doing that for good reasons, altruistic reasons, I highly doubt. I mean, it's a massive risk exposure, right? So your chief risk officer is sitting firmly on top of cyber and is not thinking of it as necessarily an ESG, but potentially a good governance measure. But in my view, it's not included in most corporations' view and line of sight when they're thinking sort of ESG and broader sustainability.
Mm-hmm. No, it's a good point. Thanks, Cara. Marcus.
Yeah, very brief. So I have not really much to add, but first of all, I think not we, but in general, we forget a little bit to understand the economic or socio-economic development we are going through. And this is something where we need technology and digital enhancement in order to deliver further level of productivity to create the social prosperity thing, because productivity in general measured on total sector productivity or whatever measure you would like to take got stalled, especially in the Western hemisphere, right? So the new kids on the block, the emerging markets or developing countries have a better advantage here because they can build all these things based on the new knowledge which exists. They do not have this entire legacy. So this is one debate, of course, we have, right? And in this context, cybersecurity is key. So if you put more focus on labor and human rights, of course, labor law will occur as well. So if you need more technology and digital frameworks, of course, then the topic is cybersecurity. So this is a logical consequence, as well as if we talk about nature, we need nature protection, or at least a way to factor nature in. So this is always a consequence of what we are doing. And then when I take this now on company level, it depends on what kind of company it is. If I take a soccer club, for instance, and I'm not a soccer fan, but it's a good example. Usually mayors are always soccer fans and using this, therefore, soccer clubs as an example, but no, it's a good example, hence I'm using it, is they make their money mainly also through advertisement through the World Wide Web. Right? So this is a security problem coming from data security and cybersecurity. They do not really have the environmental problems because they get the energy from local energy providers, etc., etc. So their problem really sits in such kind of examples. So we need to start analyzing the companies based on their main exposure, on the area of main materiality. And then we are getting there, but we all can't exclude ourselves in the 21st century from cybersecurity, right? Everyone from us who is exposed to the world outside and has data needs to have a decent approach to this. But there are companies who are more exposed and companies who are less exposed, but we will all be exposed to it, especially when we think about how globalization will change. It will be more decentralized, although globalization will further integrate over the next decades. But maybe we will more exchange intangible goods than tangible goods, because tangible goods will be produced more locally and traded more locally. So at least to be still relevant in future, you need to accept this challenge already today. And this is a digital challenge because the transformation of our society will go in this direction.
Absolutely. Thank you, Marcus. So you mentioned at the beginning of your answer the idea of obviously the need for additional technology and digital enhancement. I think one of the areas with respect to technology that's of course getting a lot of attention these days is AI. So I wanted to hear from you all kind of as a closing question, what you think about AI, whether you see it playing a role in the ESG space, whether you see it, potentially adding to some of the challenges that we face around greenwashing, misinformation, or whether you see it as, being an avenue for good. So Marcus, maybe back to you to start.
Yeah, so AI is for me really a great advantage if we use it right? So we won't stop. If the society wants to have AI, society gets AI. So debating about how we stop this is completely mistaken. So means we need now rather to discuss our ethical stance, our ethical framework, how we would like to use AI. What are the goals? What are the no-goals? And maybe we have to think like with the International Energy or Nuclear Agency, what Guterres also put forward about similar in the context of artificial intelligence to a certain degree. Just let's debate it. Because the right usage as a tool is promising. The wrong usage of it is threatening for all purposes. If you think about automated weapons, or if you think about self-learning algorithms in order to get some work done, which could immediately go also against you in the result. So these things we must debate. And then having all said this, and based on the assumption that everything will be used correctly based on the right ethical understanding, then of course this could be something which we could use as a very useful tool for analyzing big source of data, because data are attributes to the underlying host, to the underlying asset. And what we are discussing in ESG is nothing else than an additional set of attributes to an asset, the non-monetary, the non-financial attribute. And to analyze this in a big chunk, a big bulk of data through AI would be excellent. But again, let's use it rather as a tool based on a decent ethical understanding. Then I'm fine and we're having a bright outlook. But there are many, many areas for error.
And Austin, what are your thoughts on the future of AI and ESG?
Well, I don't think AI will stop with the greenwashing. I think AI is an accelerator of if you've got good data out there, it will accelerate more good data. If it's got bad data, it will accelerate the bad data. But as Marcus says, it's a tool that we should use and we should embrace it. Again, if we look back at the TMT bubble, which is actually kind of, it feels like we're almost in another bubble at the moment. Anything that's got .ai has got this magical valuation on it, and was it Nvidia at 40 times sales at last valuation. But I think in terms of will AI actually change the world as we know it? Yes, it will. Will it be good and bad? It will be both, because you can't have the good without the bad, it feels, with everything that we do. But certainly for those who are keen to adopt it and keen to adopt it in the right way, as Marcus is saying, around the ethical inputs around it, it can be an incredibly useful tool for ESG analysis, because ultimately we're talking about there being a lack of data or a lack of consistency in data. Well, AI has got the potential, when I say it's got the potential, it's not necessarily going to do it, but it's got the potential to solve that, which I'm all for. But obviously, like with every bit of system, garbage in, garbage out. So as long as you put the right data in it, AI's got the potential to be a real beneficial additive for ESG analysis.
Wonderful. Thank you, Austin. So I know we're coming up on the hour, so I did want to open up to some of the questions that we've received from people attending the webinar. One question relates to green and social bonds. It's not something that we've talked about specifically, but wanted to kind of hear your thoughts and as to whether those are, important instruments, of course, in addressing some of the issues that we've been talking about. So maybe Austin, we'll start with you.
Sure. So as Mark was saying earlier about the secondary and primary markets, so green bonds, they feel a relatively new addition to the landscape. And the problem that you've got is really understanding where that capital is being allocated. And we are seeing a lot of greenwashing in the green bond space. So companies are, they might score pretty well on the ESG, but they're not really demonstrating what they're going to do with that extra bit of capital that they're raising. So that will be the first thing for anybody who's analysing these. You actually need to see where is that new money being allocated to. And this is where governments have historically fallen down in, because you've just got this opaque funding box that all the money gets loaded into. And yes, they do good, but they also do harm. And that's the issue that we still have with these green bonds, is that there isn't that level of clarity over where that capital is being allocated to, and the green credentials, if you will, of those raised monies. Buyer beware.
And Kara, perhaps not, directly your area, but any thoughts on kind of the usefulness of green bond and social bonds and impacting some of the change that we're discussing?
Well, I think it as Austin referred, I mean, these are things that it's great these instruments are out there. It's great that sort of the treasurers and CFOs out there are trying to think of ways to raise money and use it in such a way that they feel is beneficial. The question does lie in just how beneficial are those funds going to be utilized. Certainly nobody's intentionally greenwashing, right? The risk of that is so high these days, but the potential to greenwash is super easy, and unfortunately many are just misguided and think they are doing the right thing, and in the end those funds don't go to the places that they ought to be. So luckily we don't buy underlying securities. We rely on asset managers to do that. So we expect Marcus and his team to figure those out and to dig deep and make sure that there is no greenwashing taking place, and if there is, then it's his fault.
So Marcus, given that, what are your thoughts on the space?
Yeah. So I think in general it's a great idea to have KPI linked bonds and to categorize the usage of proceeds, because this gives an idea of where the money is used for, right? Because a fixed income structure is something different than an equity structure. So you lend your money, you give your money, and some investors want to see for what it's used. I agree with this. Thankful to ICMA, International Capital Markets Association. We already had a beginning of the standard developed for green bonds. We now have the United Nations with the blue economy or blue bond principle. So it's going in this direction. But we should not narrow the market towards such categories. I rather would prefer that we really have these KPI-oriented structures, but the KPIs must be very clear and very transparent. So I think the question around the transparency and the usage of proceeds is very, very important. And we, of course, need a discussion if a polluting company is having a green project and they are getting to the market in order to get fresh capital through a fixed income structure. Can be such a bond called green bond or blue bond or sustainable bond. And I think this is a more interesting question, that the finance activity, which is then classified as sustainable, must be really clearly linked to a transformation strategy of the parent company, if you want. This is, I think, very, very important, because it's all about transparency in order to not scare the investor, right? So we are always talking about information trading at capital markets. If the information is provided in a symmetric, transparent way and solid way, no problem. If there gets a distortion in the symmetry or in the transparency, we are getting a problem.
Understood. So I know we're coming up on time, so we're not going to have a chance to get to all of the wonderful questions that have been submitted. But for a closing question for the panelists, maybe would like to hear your collective thoughts on where you see the industry in 5 to 10 years. Kara, maybe we'll start with you.
Well, certainly hope that ESG is no longer contentious and is just an agreed upon standard, right? You know, nobody has an issue with price to book, as was mentioned earlier, right? Like, who's going to throw a fit about that? So that would be my first one. I'd like to see impact funds being clearly articulated as to what they are expected to impact, and good metrics around whether or not those impacts are actually taking place. And I do think that in general, the consumer and the end investor is going to have much higher expectations of their managers and the products that they, you know, the corporates that make the products they buy have better taken more consideration as to the overall impact of what they're doing. So across all aspects of ESG.
Wonderful, thanks, Kara. Marcus, your closing thoughts.
Yeah, my closing thoughts are that we as a society understand that the financial market is an intermediary and is part of the solution, point number one. And we are part of the solution in order to get the money flowing in the direction where it's needed, under the consideration that we are embedded in nature and dependent on nature. Hence, it would be irrational to destroy it, because then we destroy the machine which sustains us, number one. Number two, that we are as companies embedded in society. And if we do not create a link to society, we will lose the license to operate. And C, if we do not base this on a good governance and a prudent, transparent incentive structure, that no investor will trust us. So these three things are, for me, really the direction of travel, based on the understanding why we are doing this. This is not a hobby. This is a necessity. And hence, for me, an enhancement of how we understand finance and economics as a tool in order to answer the questions we have, and not as a goal itself. And I hope that we will get this enlightenment on the road within the next couple of years. And I'm hopeful, even if we still have a lot of work in front of us, but this is the reason why we're here, right?
Absolutely, yeah. And Austin, your closing thoughts on where you see the industry in 5 to 10 years.
Well, I hope we won't be talking about ESG funds I hope every fund will be properly ESG, whereas we're still in that transition phase. So that's where I see the direction of travel. I see regulation coming in and shoring up and giving a bit more clarity around some of these terms. And we mentioned, what does sustainable or responsible mean? Energy transition, number of funds, SFDR 8, Article 9, that hold oil majors in there. That cannot be allowed to happen. So I think that's where we're going to see a lot of improvements. And adding to what Marcus said, we are part of the solution. We're not the only one. We need to work with all stakeholders, whether you are legislators, whether you're politicians, whether autocrats, dictators, at least you can get stuff done quicker, right? But as long as we can all work together, agree the framework, companies abide by the rules in their local jurisdictions. And that's where it's falling down, is that those rules are too laissez-faire. They're letting these companies get away. And I don't want to label it just to companies. Companies are not the only ones at fault. But ultimately, you play by the rules you give them. And if your rules are too lax, then you might be lax. If your rules are tighter, you'll be a bit tighter. So that's really where I would urge anyone who is in a position of authority in order to actually, let's look at the rules of engagement and let's set it so that capital markets work with legislators, work with governments. Society can be damaged or it can be enhanced through what we do. We're not the only ones, but we can all work together. We know where we want to get to. If you ask people individually who are ethically minded, do you care about the environment? Of course, the answer is yes. But when you've got these unconscious biases or these unpredictable or unknown consequences of your actions, that's where it becomes a little bit harder to make informed decisions. And what I would also say, not related to this, I know there are some questions we can't answer. Anybody feel free to contact me on LinkedIn. Particularly if it's around funds, I'm happy to answer it. I obviously appreciate that Marcus and Cara probably have got more expertise in other areas, but I do see one of them about funds. So I would like to answer that, but I can't now. So contact me, Christoph, and we'll hopefully I'll give you a good answer.
Wonderful. Thank you, Austin. So with that, we'll bring today's webinar to a close. I would like to thank Evenco for co-hosting with Bloomberg Intelligence. And of course, would like to thank our wonderful panelists for what I thought was a wonderful discussion this morning. And as Austin said, for those who did not get questions answered, or for those who want to hear more from us, I'm sure we're all open to getting questions on LinkedIn. So please don't hesitate to reach out. And with that, we will end the conversation. Thank you all so much. Bye-bye.
Thank you. Bye.